now to welcome our guest Anand Tandon, who's a market expert. Anand, welcome to the show. A very good afternoon to you. So how are you viewing the current mood on Dalal Street? Third day of declines coming in for the key benchmarks.
Well, the benchmarks may be a little easing off a bit, but by and large, the mood remains reasonably buoyant, I think, because if you look at where the market is, it is not showing any major signs of discomfort. The valuations are back at the levels, and the levels itself are back at where they were in September 24, where the market was looking fairly stretched. And since then, if at all, the macros have actually deteriorated globally. India, of course, is in a bit of a sweet spot. Inflation is down, energy prices are down, therefore, current account deficit may remain slightly under control. But broadly speaking, the global picture for growth is a little dimmer than it was in September, and yet we are where we are. So I think the market mood is reasonably robust.
Right, Anand, like you were mentioning, valuations continue to be high. Now, do you see any correction coming anytime soon, especially in the small and mid-cap space, or do you think large caps are, going to be the preferred space?
Well, despite some amount of give in terms of the valuations of the mid cap and small cap space, they continue to remain at a premium, and the market itself is at more than one standard deviation, almost two standard deviation away from the mean on the upside. So, in a situation where the earnings have come down to single digit growth, and mid single digit growth, you are still looking at a market which is trading at, let's say, around 22 times 1 year forward. And if you were to remove, let's say, the banking and financial services, it's probably trading closer to 24, 25 times 1 year forward. So for a market which is largely commodity driven, or at least substantially commodity driven, to trade at that valuation means you are already stretched. And on top of that, like I said, the broader market is even more expensive. So for the near term, I think there is not much upside in terms of where the market can be headed, unless we see some surprises going forward in terms of either huge inflows or something which triggers a possible great improvement in the outlook for the earnings going forward.
Okay, Anand, I also want to get your view on tariffs going forward. Now, how do you compare Indian markets to global markets, especially given tariffs that are, likely to come in over the next few months? Now, the handover from Wall Street was very positive, but we continue to see a decline back home.
Well, the tariffs will, I assume you're talking about the US tariffs. That will eventually end up. So, first of all, can it go back to where it was in the past? I don't think so. You are looking at a situation where the US also needs to raise some amount of revenues, given the kind of big, beautiful bill that they are putting up, which is going to increase their fiscal deficit. And they need to find some means of compensating for that. So, you are going to have tariffs which are higher. Now, in that context, the market tends to believe that whatever you are seeing today will continue forever. The reality is not as simple. So I would imagine that if you have tariffs, you will have two features coming through. One, that supply chains will come, the current supply chains have to be recrafted. And to a large extent, strategically, I think most countries are going to look at near shoring or perhaps onshoring of at least part of their supply chains. Now, that is both a threat and an opportunity. In a slowing down environment globally for GDP, you cannot have India grossly outperforming. On the other hand, if we were to create a situation in the country where we offer ourselves a better investment decisions for some amount of increase in manufacturing, and not just on PLIs, which are dependent on subsidy, etc., but generally improve the industrial outlook, I think you will have a reasonable amount of offshoring happening out of India, more manufacturing base shifting to India for the domestic market as well as the international market. So I think it's a question of an opportunity which we need to grab with both hands. If the governments in the states and the center are willing to do that, obviously things can improve. But if they were not, I think overall there will be a negative impact. In India itself, the fact is that we have been putting up walls of tariff against China, etc. And perhaps to some extent, we may have to do more of that, because with China finding it more difficult to sell to, let's say, the US, that amount of goods and services, the goods that they are going to produce have to be redirected to other countries. And clearly one of the countries, which is, because the economy is doing well, which will be in a position to import, will be India. And therefore, you should expect to see more pressure on Indian manufacturers coming in from goods from China, which needs to be offset therefore by tariffs. So our own tariffs will continue to perhaps go up and provide protection. Overall, we need to find ways to make India more competitive as a manufacturing destination, and that is a problem that we still haven't managed to lick.
That's right. Now, you did say that supply chains will have to be readjusted and that the manufacturing space is going to be in focus in the back of tariffs. But within the manufacturing space, are there any particular spaces that you think one should be watching out for, in order to, since you say India needs to become more competitive. So any particular spaces within the manufacturing space that you think one should be watching out for that you're bullish on?
So clearly, if you look at what the government has done in terms of spending money on infrastructure, we have seen a lot of development happening in manufacturing in terms of railways, for example, because you have gone and put out orders, and because it's a monopoly buyer, they had to put out orders if you want to make wagons, if you want to make, rolling stock, and so on. So that is one clear area where we've seen an improvement. The same thing goes for defense, and I think that's a more sustainable kind of longer term picture, because if we really continue to improve our defense manufacturing capabilities domestically, and I think that's becoming more and more evident that that is something that we'll have to bring on shore to as much extent as we can. That's clearly another area where manufacturing has to be improved. For most of the others, we are reliant on PLI. I mean, we are doing PLI for everything from pharmaceuticals to mobile telephones and so on. But the value addition, for example, in mobile telephone continues to remain bleak. Now, going forward, there is a possibility that with more and better quality onshoring of components, it may improve the overall value addition in India. But that is what I was saying, that we need to move away from the subsidy-driven business and move into making cost of manufacturing in India cheaper because of lower cost of infrastructure, lower cost of logistics, and perhaps a cleaner government and easier way of getting permissions and a legal process which does not change after 3 or 4 years, all of which go to increase cost of doing business currently. So the areas that we are doing well, for example, where I would expect, for example, to have a better outlook would be textiles. With Bangladesh being in a bit of a problem, a soup, and China itself also having tariffs, etc. That could be one area, for example, which India, without much help, can actually improve if we were to allow, for example, synthetics to be imported at slightly better tariffs than we have currently. So there are several areas where we can actually do well. Defense exports is another area. But as I said, the outlook has to become a little less protectionist and a little more efficient in terms of how we allow Indian manufacturing to work.
All right. Hi, good afternoon, Mr. Tandon. This is Shrishti also joining in. Great to be speaking with you. And firstly, wanted to have your take on the insurance pack. Help us understand what's really changing for the insurance industry, if at all, because this is one of those areas which definitely offers a great size of growth, great opportunity of growth, but nothing really much has transpired into the numbers. And along with that, there were some regulatory hurdles impacting the growth. But do you believe that there's something that is fundamentally changing for the insurance pack and the companies that are in the listed space? Maybe this is the time to look forward to them.
So as you said, Shruti, this is first of all a space which is very large. And, earlier we used to say that insurance is a place where India is underinsured. If you look at the number of policies sold, it is not so much underinsured anymore. But in terms of the value of the policies, I think there is still a long way to go. And more importantly, people continue to confuse investments and insurance. So a large amount of the sales that are happening of new policies continue to be ULIP linked. Which is not necessarily the best way that you should be buying insurance. Insurance is a protection product. You should be buying protection. Investments are best done through other structures like mutual funds, etc. But be that as it may, it provides an opportunity for insurance companies to continue to penetrate the market and upscale the size of the policies, as well as bring more complexity in terms of the coverage that they are offering. Given the fact that we are also looking at life insurance companies being allowed to enter into other areas, I think you will continue to get growth. The biggest of the lot, LIC, for example, if you look at the latest results, they are now getting more and more into non-participating policies. And anyway, they are now allowed to, there's still some scope for them to increase the retention that they have from even the participating policies. So overall, I think the earnings growth can be quite good. More importantly, the company itself is valued at almost at a discount to their portfolio. So it's not particularly expensive either which way. For the others, the growth has been a little, should I say, not as secular as one should have expected. But if that's mostly because of the fact that we had some challenges suddenly when the regulator kind of indicated that companies which are related to banks should not be selling their entire products through the banks and so on. And the bank assurance business went into a bit of a flux. But I think that's now back, and I think you should continue to see the growth there. More importantly, once you bought a client in, the client has to stay with you for years. So it's a long-term business which continues to accumulate capital, and therefore your ability to generate money out of it. To my mind, it remains one of the core areas for growth and investments on a very long-term basis in the country.
All right. Along with that, Mr. Tandon, share your thoughts on the power generation theme as well, because for the past 2 to 3 years, we have been seeing all these companies related to the power space. They have been doing very well. Yes, the numbers did tell us the story and the reason why they were buzzing. But now, do you believe it's time for them to take the breather, or rather they are fully valued at these price points?
So, we had, if you go back 10 years, let's say you had a situation where, or even 15 years, you had a situation where everybody thought that was the pot at the end of the rainbow. And everyone set up fairly large capacities, and, mega plants were set up for power generation, much of which linked to international coal, and that became a problem going forward. Then we had the reverse, where the growth in the demand was fairly inimical. And for the longest time, almost 4 or 5 years, we had a situation where merchant power was trading at below cost, perhaps. And that had become a problem. Most companies were not willing to get into, most utilities, the distribution utilities were not willing to enter into long-term agreement. That too has turned, and we now have a situation where you could have bought capacity at, let's say, 2 to 3 crores per megawatt, which costing almost $1 million to set up. And now you've got a situation where the market is trading these at multiples of the cost to set up. I think both sides, the market tends to overdo whatever it's supposed to. Currently, the demand for power is obviously doing quite well, and therefore new capacity is needed, which is happening, but it's happening, much more aggressively on the renewable space, which is causing problems for the transmission business, because until we set up more batteries, transmission is going to be under stress because of the cyclical or because of the non-predictable nature of renewables. So net, we have a situation where the power generation companies are putting up new facilities and therefore are going to benefit from that. But it's the ones that are going to get regulatory tariffs like the NTPCs of the world should not be trading as growth sectors, because finally there is a certain amount of value that you can attach to the NPV of their future cash flows. And that's not going to change very much, because, as I said, these are all PPAs which are then set up and last over a couple of decades at least. So the market is tending to treat them as growth stocks. If one has to look at growth, I think one of the areas that we continue to need more investment is transmission, where the likes of Power Grid, etc., have actually got regulated return on capital. There again, they are perhaps a bit overshooting a bit in terms of the capacity they are putting up and the valuation that they are trading at. But overall, at least the numbers will come through. There is no doubt that as they put up more transmission capacity, that will be fully utilized, and therefore they will get their regulatory return on capital. So it's a steady business. It's a business which is highly predictable. It is in the growth phase, but the only question is you have to figure out when you are going to be buying them, because they are not actually stocks which will show outsized growth beyond what the capacities are.
Okay. Thank you, Mr. Tandon, for that view. So transmission is the pocket where you see growth within that power segment. But with that, we'll let you go. Thank you so much for joining us and helping us decode the current market trend. And with that, it's time.
If you like this video, then like, share and subscribe to ET Now.